Now let us see what are the different types of debt funds available for investors. The first in the category is liquid funds. Those investors who want to park their money from 1 day to 3 months can invest in liquid funds. Post demonetization, 99% of the household in India today have at least one person with a bank account. The primary objective of bank account is to protect the money invested and to earn interest on it. Liquid fund offer better returns than saving account. Investors can expect a return of 6% to 7% in liquid funds. Liquid funds are open-ended schemes that invest in securities with maturity up to 91 days. That is, the average maturity of securities in liquid fund will be around 91 days. Let us assume that Mr. Vivek maintains an average monthly balance of 3 lakh rupees in saving account and in current account, and he maintains this balance for 1 year. The interest earned on current account is 0 and in saving account is 3.5%. He will earn 0 rupees in current account and rupees 10,500 in saving account. Mr. Vivek, instead of keeping his money in current account or in saving account, if he invests his money in liquid fund, he can earn a return of around 6%. That is, he will make rupees 18,000 by investing in liquid fund. So, with the benefit of liquidity, investors can now earn better returns than saving account by investing in liquid funds. NJ Wealth Partners can now offer InstaCash facility to their clients, which can be best alternative to saving account. That is, through NJ's Demat accounts, partners can offer InstaCash facility to their clients. It offers liquidity and higher returns than saving and current account. It is so liquid that redemption amount is credited to the investor's account within 30 minutes of transaction. Investor can withdraw up to 50,000 rupees in a day. NJ partners can easily build AUA by promoting InstaCash to the client as an alternative tool to saving account. For example, if 500 investors invest 1 lakh rupees each through InstaCash, partner can easily build a AUA of 5 crores in short term. The next type of debt fund is short-term funds. Short-term funds are ideal for those investors who are looking to park their money or invest their money for a time horizon of 3 months to 1 year. Short-term debt funds invest in debt securities who have a maturity between 3 months to 1 year. That is, the average maturity of debt securities in the portfolio will be between 3 months to 1 year. Short-term funds are better alternative to bank deposits because they offer liquidity and are less volatile. Short-term funds can also offer better returns than bank deposits. One of the basic thumb rule used for investing in debt fund is the horizon of investment should match with the duration of the fund. Duration measures the interest rate sensitivity of the fund. For example, if an investor is looking to invest in a debt fund for 1 year, then he should invest in that fund whose duration is around 1. Lower the duration, lower will be the volatility, and higher the duration, higher will be the volatility. So, short-term funds are ideal for those investors who are looking to park their money or invest their money for a time horizon of 3 months to 1 year. For example, if an investor has accumulated 50 lakh rupees for buying a house, and due to certain circumstances the deal got delayed for 10 months. So instead of keeping his money in saving account or in bank FD, investor should invest his money in short-term funds. The next category of debt fund is accrual fund. Investors who want to invest their money in debt funds for more than 1 year should invest their money in accrual funds. Debt funds generally earn through interest income and capital appreciation. Interest income can be in form of coupon payment and capital appreciation in form of price change. The primary objective of the accrual fund is to earn interest income. Accrual funds can also earn through capital gains, that is through price change, but that forms a small part of overall return. Majority of the income in accrual fund is due to interest income. Accrual funds adopt the strategy of buy and hold. That means accrual funds generally hold the securities till maturity. Accrual funds not only offer indexation benefit but also provide liquidity and better returns than bank deposits. Therefore, accrual funds are suitable for those investors who invest their money in bank FDs for 3 years and more. Investors who are looking for less volatile funds and stable returns should generally invest in accrual funds. The next category of debt fund is monthly income plan, also known as MIPs. If an investor is looking for better returns than debt funds with a minimal exposure to equity, then he should invest in MIP plans of mutual fund. Monthly income plan invest in both equity and debt asset class. The equity component in MIP is around 10% to 30% and rest is invested in debt. Equity component in MIP helps investor to get better returns than debt fund. MIP is nothing but a debt-oriented mutual fund which gives you income in form of dividends and capital appreciation. The income you get from MIP is not limited to monthly option. Investors can also choose to receive income quarterly or half yearly or yearly. Just like any other mutual fund, MIP also comes with two options, growth and dividend. However, one should also note that there is no guarantee of regular monthly dividend. Dividend payout of the scheme will depend upon the performance and objective of the scheme. MIPs are more volatile than debt funds and less volatile than equity funds. Investors can expect 1% or 2% higher returns in MIP than liquid funds.